all. And
Hey, Iris.
Hi, Iris.
Hi, everyone. I'm so sorry to keep you guys waiting. Wrong link. Thank you so much for your patience.
Oh, no worries at all. We're just waiting for everybody to get logged in.
Okay, great.
And so while we just wait for a couple people more to trickle in, can I just do a quick, if you lay a few ground rules for today?
Sure, absolutely.
Okay, awesome. Well, first, thank you everyone for coming. Jared's going to be doing this interview, and thank you, Iris, for joining us too today. We will be recording this just so that everyone knows. And this is one of our first Quarantine Talk series. So this is an experiment. We're looking for feedback here. Everyone will be on mute. And then in terms of the structure and format, we have the Q&A, or the talk will be about 40 minutes. And then we'll have 20 minutes for Q&A at the end. So please just put your questions into the chat box or send them directly to me. And I will forward them on to Jared. And yeah, that's all there is for now. Thank you. Welcome.
Great. Well, thank you, Shannon, for taking care of all of the technology today. I want to welcome everybody to this webinar and say a special thank you to Iris for joining us. We really appreciate it. This webinar is sponsored by WAFA, which is the Wharton Alumni Founders and Funders Association. I'm Jerry Houston, one of the board members for WAFA, and we're a nonprofit alumni club that is on a mission to help female founders and funders. So for those of you who may not be as familiar with WAFA, we've been around for almost 2 years now. It'll be our 2-year anniversary this summer. And we were founded because we learned that only 13% of Penn founders are women. And those women are only raising 6% of the VC dollars awarded to Penn founders. And so we think that we can do better as an alumni community. And that's the mission of our organization, is to help support our female and other founders and burgeoning funders. So with that, I just want to say again, thank you to Iris, and want to dive in. I'm going to stop sharing my screen just so that everybody knows where they are. And yeah, I would really love to kick it off if you wouldn't mind introducing yourself and Floodgate, the special focus of Floodgate, and why I think it's so relevant for this discussion today. Most of our members are really early stage founders or aspiring founders, so I think they're going to really benefit from your perspective.
Yeah, that's fantastic. I'm really happy to be taking part in the conversation. So thank you so much for inviting me. So I'm Iris Choi. I'm a partner at a seed stage fund called Floodgate. We're based in the Bay Area, although we invest primarily in the United States. We have a couple of international investments, but those are more outliers for us. And I am a Wharton alum. I got my MBA in 2004. And my path of venture is a little bit unconventional in that I basically had a career in investment banking before joining Floodgate. I've been at Floodgate now for 7.5 years. I was the first non-founding partner to join. And even within Floodgate, my path has been a little bit non-traditional as well. So happy to give a little bit more color. I would say coming out of Wharton, I joined Goldman Sachs in San Francisco, primarily focused on M&A for tech and media companies. And I think that's a helpful color because it'll be relevant for my path even within Floodgate. As a fund, we're currently investing out of our 6th fund. And when I say we're seed, what that means is that we're usually the first institutional round of money that a company takes. And venture is funny, and it's continuing to evolve like any other industry in that, oftentimes people ask me, well, what's too early for Floodgate? And in theory, nothing is, right? Like there is kind of no need for a sector in advance of seed. There has been the evolution of a sector called pre-seed, but I think we like to think of ourselves as going into back companies where they're in the 0 to 1 phase. So maybe you're a student who has an idea and you're looking for a small round of funding to be able to test it out. Maybe you've bootstrapped, and so you actually have revenue, but now you're looking to scale. For us, it's really about when are you at the stage where you are testing for product market fit, but don't necessarily have evidence yet. And so it's very different than if you are, for example, at a scale of, tens of millions of ARR, even though you're bootstrapped, that's probably more likely to be growth equity. And we're more likely to be willing to take on the risk of getting in super early, but in the hopes of getting a certain amount of ownership at a very attractive valuation, and then being diluted down over time. We're fairly evenly split between consumer and enterprise. We're small. There's only 4 partners, 4 investing partners. And when I had referenced earlier that even my path with Inflate gets a little bit non-traditional. So usually you don't find a lot of former investment bankers at the seed stage. But when I joined, I was actually primarily focused on not the investing, but more so the portfolio management. So taking board seats, really thinking about what is the path to the exit for any of our companies. And that I think is also unique at the early stages. I'm a big believer that while there's a lot of luck and hard work involved in any opportunity, that you have to be intentional about the exit path you want to be on. So whether you think that you are going to be able to scale on a standalone business to the extent that you can go public at some point in the future for billions of dollars, or you feel like your more likely exit path is going to be acquired by someone after you've already reached a certain amount of scale. Those are two very different paths. And you may find some companies that can kind of thread the needle between both. Like Qualtrics is a great example of a company that sold literally the day that they were supposed to price their IPO for about $8 billion. But it's rare because there are going to be very different relationships and a different approach to your ecosystem if you're looking to be a standalone company versus selling. And so that's where I'd spend the bulk of my time in my early years. But over the last couple of years, we've run an experiment. I feel like hopefully it's kind of evolving past an experiment phase where we realize that like most funds, we reserve a portion of our fund for what we call follow-on investing. So we write first checks into a company, and then the expectation is for most funds that you continue to support that company, and that you would want to, that your companies are doing well, so you'd want to lean in and continue to either maintain or actually increase your ownership over time. And so that's actually where I spend the bulk of my time. And it works well with my skill set because I'm used to working with companies at various stages, especially the more mature stages. And so we think about our reserves almost like a lot of other funds think about raising opportunity funds, where when you feel like there's a breakout hit within your portfolio, you want to be able to double down on those opportunities and really go for the long run. And so that's how we're kind of operating our reserves at Floodgate.
Thank you. I mean, it's so unique. I think Floodgate and has such a wonderful reputation for seed and then supporting seed founders. That's kind of, I think, what the firm is known for. I'm curious, how should early stage startups approach Floodgate, especially in this environment?
Yeah. And so just a little bit about kind of the environment that we're in, right? And this is one where it's interesting because I have a perspective having worked with publicly traded companies for such a long time and the trickle effect of the public markets versus the private markets. And so it would be totally fair if you are a startup founder to wonder why are VCs so fixated on the public markets. And there's a couple of effects I would point to. One is that the public markets are really the marker of valuation for companies. I mean, obviously, we're not going to be applying the same multiples as a company that's publicly traded to something at seed stage. But to my earlier comments, you kind of want to know what path you're on. And so what you're going to see is that there is going to be a lag, but as public market valuations come down, the valuation expectations by VCs and founders are going to come down in probably 6 to 12 months afterwards. And so you will probably see even high quality companies raising at less of an up round than you would have seen over the last couple of years. So there's the valuation impact that's going to be happening. The second part is also that as VCs see that it is going to be more challenging for the IPO markets to reopen over the next couple of years, we're really going to have to think about, okay, so then it is less likely we're going to get immediate liquidity. And so we're going to be more focused on helping our existing companies and not necessarily assuming that there's going to be a quick exit where we can redeploy that capital then into new investments. And so you probably have heard about VCs saying they're open for business, but practically speaking, they're probably spending, at least in the early days of the shelter-in-place period, really focusing on their existing portfolio companies and making sure that the companies they've already invested in have enough capital on hand to continue to not only survive this, weird period that we're in, but really try to thrive and be successful coming out of this period. And then the last point I would just make is that the volatility in the stock market and the downward pressure does actually impact VCs in so much as a lot of our limited partners, the foundations, the pension funds, the endowments from whom we get the capital that we can deploy in our funds, oftentimes will want to rebalance their portfolio. And so venture, the private markets, is only one sliver of the pie, and they also invest in real estate and commodities and public markets. And so as the value of some of those other asset classes decreases, some LPs will actually pull back from venture. That's, I would argue, less likely impact the venture funds that are already fully funded, but it may slow down the pace at which venture funds can go out and raise new funds, and that will impact the fundraising environment over the next couple of years. So my general advice for founders that want to approach Floodgate or Seed is you have to have obviously a very compelling pitch, right? And the environment does influence your narrative. So whereas in the past couple of years, I think what people really prioritized was how quickly can you grow and how quickly can you get to scale, and what is the path to you just like dominating your competitive landscape. I think these days people are going to want to understand how can you grow in a capital efficient manner. And so I know one of the topics that we're going to cover today is this concept of intelligent growth. And this is something that we've really emphasized at Floodgate over the last, I would argue, kind of 5 years. And so definitely in pre-COVID times. And it means that even when capital is aplenty and it feels like it's very easy to raise funds, that you as a founder and as a company should be very attuned to whether or not you are generating value. And what I mean by that is not necessarily, are you getting an up round, although that could be one indicator of whether people ascribe value to what you're producing, but that you shouldn't over rotate to just this concept of product market fit. It's definitely a very important indicator, right? You want to produce, Paul Graham says it, right? You want to produce something that people will buy, like people actually want. That's obviously critical. I mean, otherwise it's not a good use of your time. But how you gauge whether or not you're generating value, I think is important. And there's a lot of great content out there about product market fit, right? And it kind of ranges along the spectrum of you want to create moments of delight for your customer, or you want to create a product that is so critical to your customer base that they are literally pulling the product out of the hands of the company instead of the company having to use marketing and sales to push the product out into the environment. And so all of those, I think, are still true, and you want that evidence of product market fit. But you also want to build a company where you have a very deep understanding of the ecosystem that you're entering. Now, this part gets a little bit tricky because sometimes the best companies aren't actually replacing an incumbent. They're creating a brand new category. An example I would give from our portfolio of this would be Lyft. Right? Lyft is very early, I would argue, the pioneer for the ride sharing economy. So could you spin that as, yeah, but there were taxis beforehand? Maybe, but actually part of the reason why people love the service is there weren't enough taxis, right? And it was a very different experience. I would say definitely on the supply side that didn't exist, right? They weren't looking for professional chauffeurs. They were letting anyone with a car be able to offer someone else a ride. And so what's important here, though, is that Lyft, in entering their market, did understand that there was an ecosystem to which they would be kind of grouped in, right? That was highly regulated, and that had incumbents that were probably going to put lobbyists and the force of all their money behind them to try to compete against Lyft. And so they were very thoughtful, I would argue, in their approach, right? So from the regulatory perspective, what were going to be the most likely points of pushback? What is the safety concerns? And so Lyft was very kind of proactive about saying, okay, we're going to run criminal checks on all of our drivers. They were very thoughtful as to how they could compete, but to be frank, be good citizens within this ecosystem that they would now be a part of. And then, so we've talked about kind of, not only moments of delight, but this concept of product market fit. What is the ecosystem that you're entering into, and how are you going to be able to play in that ecosystem? And then the third kind of leg of the stool that we'd like to talk about at Floodgate is, what is your business model? And having a sense of that from the very beginning. And, this was a concept that, to be frank, was probably unpopular to talk about over the last couple of years, because it feels like, oh, you're a VC and you're just trying to figure out like what's the exit or what is monetization. But I'm building this incredible product, and it's very popular to think like, if I build it, they will come, right? I'm gonna either solve something for technology's sake, or it's just going to be so compelling that inevitably someone will pay for it at some point. That may have been true a couple of years ago, and there may be outlier kind of black swan instances where it's still true. It's just become a lot harder. And the example I would give is social networks or kind of anything in the media space, right? The expectation was once you build an audience that's large enough, you can just turn on monetization, because the information that you'll have about the ability to target based on demographics will be so great that people will automatically flock to your network. That hasn't proven to be the case over the last couple of years, because Google, Facebook, Instagram, the incumbents have have been able to actually increase their share of the wallet for any advertisers. So the likelihood that someone new comes in and is able to draw those dollars away, I think is harder to believe going forward than it maybe had been in the past. And so I do think that you don't have to turn on monetization from the beginning, but understanding what your business model is going to be in the future is something that's going to be important for you to be able to relay even at the early stages of seed, because we need to know that at some point there is a business model and it's going to be viable. Especially in consumer, I think there have been a lot of cases of companies that check the box in terms of like incredible moments of delight, right? We're able to ramp very quickly in terms of engagement and number of users. But then when they tried to figure out the monetization, things just didn't click. And so an example I would give of this is Foursquare. Right? It was such the darling of Silicon Valley, even though it's based in New York, and as well as, the VC startup ecosystem. People wanted to be the first to check in and be the mayor of like a town or a business that they were first to bring onto the system. And then they transitioned their business model and tried selling kind of the data aspect to like hedge funds and others. There were examples of, Foursquare can give you a sense of foot traffic going into fast casual restaurants. But none of those ever actually caught up to the brand, meaning that, so many people knew of Foursquare and liked engaging with it, but the monetization capabilities never kind of came to full fruition. And so that's something that we feel like we've seen enough data points where we understand now that from the beginning, you want to have a very good sense of what could be the scale of the business model as well.
Yeah, I mean, that was awesome, right? That's a lot to think about, especially if you're a seed stage company, when right now you might just be trying to stay alive so you can continue to, support your team. And I think there are a lot of companies now that are looking at making these pivots given the difference in the environment, right? Of trying to, hey, can we deliver things via cars, right? It has to be in-home delivery, or can we turn our content into something that is virtual, like we're doing right now, right? How are VCs thinking about, the changes that companies are making, and how can companies try to make smart changes? Because it wastes a lot of time and spend a lot of money on something that maybe is not relevant if we can ever leave our homes again.
Yeah, no, absolutely. So there's a lot packed in there that I would love to cover. So there's a couple of key elements. I will say that, at Floodgate, we have also been spending a lot of time with our existing portfolio companies trying to coach them through. There is not going to be a short-term return to quote unquote normal, right? If normal to you means when do we go back to how we were behaving in 2019, that's unlikely to happen, to be frank, for the next couple of years, right? Until there is a vaccine that has been proven and widely distributed, it is unlikely, even once restaurants are open, that you'll be able to have the same capacity in terms of clients allowed in at any given time. And people are saying, even as states start to open up offices again, right, there will be likely a maximum of 50% of people allowed in at any given point in time. So our behaviors will have fundamentally changed over the next couple of years. And that's a bitter pill to swallow, right? I mean, I think it's hard emotionally for each one of us to try to kind of understand that and actually reflect on what that means for each of us going forward. I think from a founder's perspective, I have been amazed by how courageous and fast acting our founders have been in terms of trying to figure out creative ways to make sure they have a runway that will last them 2 to 3 years. And I know that's very daunting to hear, especially for someone who hasn't necessarily fundraised or maybe only had raised a small amount. But I think for all the reasons we just talked through, in terms of, VCs being nervous or having their own funds, maybe have to last them for longer. As a founder, it does make sense right now to try to say, with the money that I have, how can I elongate my runway? And that may mean that you have to lay off some of your personnel. It may mean that you let go of subscription services like AWS and others and be able to cut corners wherever you can. The other way then is to say, well, how can I start monetizing, right? And maybe you weren't ready to monetize for your core product, but is there technology that you've built that others might want to license from you, right? Are there ways that you can be creative about what you're currently doing? And some of this may be stuff that you're willing to put up as a product during this weird period of shelter in place, or while we're not kind of actually out and about per usual. And that may not be your post-COVID business model, but it's enough to get you by for now, right? And one of the things that I've noticed is people often talk about during market downturns, some of the best companies are created. And I believe that's true, right? Because what kind of crazy person wants to start a new company in the environment that I just described where, you know, funding may not be available. But if you think back to, you know, one of the classic examples that people like to point to is Airbnb. Airbnb, when they were going around pitching for their seed round, they were selling boxes of cereal, right? That they had repurposed and put on new covers because it was John McCain and Barack Obama competing for to be voted in as president. And so they were figuring out hacks that would cover their living expenses and costs that had nothing to do with launching, you know, Air Bed and Breakfast. And so there is that question of like, can you do other things? An example I would give from Floodgate's portfolio is there is a company in our portfolio called Air Garage, where they were finding a way for churches, you know, libraries, people who had parking lots to be able to monetize those parking lots. So if you are a student at ASU, it's really hard to get on-campus parking, but there's a bunch of, you know, mom and pop shops right on the periphery. What if they were instead able to rent you the parking space? Well, as you can imagine, their revenue stream precipitously declined during shelter in place. Nobody needs parking. We're not even leaving our own homes. And so what they've done is said, okay, well, we have the space. So what we're going to do is offer drive-through groceries. And so we will source from another Floodgate portfolio company of ours called Cheetah that usually sells bulk wholesale, so meant to go to restaurants, not to individual groceries, broke them up into smaller packets, immediately launched an app through which consumers could order their groceries, and then set it up in the parking lots that they had access to, where you drive through, pop open your trunk, it gets put in your car and it's completely contactless, right? And now I would argue for Air Garage, that's probably not going to be a product offering necessarily going forward, but what they need to do is be able to survive so that they can at least make it out on the other side and continue building their core product. And so unfortunately, I think during this period, there is partly just that you need to find a way to survive. Now the hope would be finding the way to survive allows you to have enough cash to stay afloat while a portion of your team continues to build on the core product. But in the absence of being able to either, you know, cut costs enough, do an insider round, go back to the people who are already invested in you, who believe in your vision, to try to increase your budget a little bit, people are definitely going to have to become creative.
Yeah, that's an awesome story. And I'll put a plug in for Cheetah. Like, it's a great way to get groceries if you need groceries, right? I don't know where they
just
operate.
talking about this yesterday.
I was literally telling Shannon, yeah, here are some places you can get groceries.
Yeah, no, that's fantastic. And it's fun because I think, you know, they've doing their best to actually break down the sizes, because they've also launched what we consider in the industry to be micro-fulfillment centers, right? So if you're willing to come to their 2 locations in San Francisco proper, and I think they've opened one up in East Bay, then you can do the same thing where you drive through. And for me, what's exciting about them testing that out is when you think about direct-to-consumer delivery, usually when the unit economics don't make a lot of sense, it's because of that last mile. But imagine a future version of Cheetah where if you work at like Facebook or Google or in an office park, instead of you having to go to the grocery store, what if via an app you could do your weekly grocery shopping and then pick it up from the parking lot you're in anyways at your big office park, right? I mean, to me, that's a different experience than what's currently offered via like Instacart and others, but it's fairly seamless. So I love that how quickly they were able to spin up new versions of their product that they can potentially continue carrying out and building on even in this post-COVID period.
Yeah, I mean, there's just been so much ingenuity from so many founders. It's been pretty awesome to watch what people are doing. And I wonder if you can think back to 2008, and then maybe even back to, you know, 2000, 2001. People are always trying to compare. I've seen a lot of folks, you know, on Twitter, pundits saying, okay, this feels different than 08. In 08, I wasn't like staying up at night. I wonder how the increase in the allocated funds to VC changes that equation, because I mean, correct me if I'm wrong, but there's a lot more money in VC today than there was in 08 and certainly in 2000. is that making things easier, better, or not really?
Yeah, no, it's an interesting point, because I was going to say, from a broader like macro perspective, there's a couple things that feel different about this economic reset or crisis versus the prior ones. And one of them is that it's global, right? And so if you think about even the 2008 financial crisis, and then the 2000 bubble bursting NASDAQ correction, or 2001 9/11, it wasn't something that was reverberating around the world, right? Other regions were doing fine, even though the US economy had really slowed down. And so there's the aspect of like, you can't necessarily escape this by redistributing your portfolio, right? Or for me to say, well, I'm just going to invest in a different geography, won't necessarily allow for new opportunities. And then there's obviously the human element, which is also very hard, where we don't necessarily have a sense of like, when is the coronavirus or COVID-19 going to get stamped out? And there's this fear that it's going to be around for a couple of years. And already a lot of not only epidemiologists, but economists are predicting that there's going to be a resurgence in the fall. So it feels like there is no safe zone that we're necessarily trying to go towards. And so I would say on a macro level, there's those aspects. And then to your question specifically around, if I would use some different words, that there's a lot of dry powder, right? So many funds had raised over the last couple of years at a significantly larger scale than anything that we'd seen before. And what you're seeing is that there are still funds being announced, right? So Lightspeed last week had announced that they had raised like $2.4 billion over 3 funds. And that's meaningful, right? And so shouldn't they continue to invest? And I think that the good news is there is dry powder. I think the hard news is that a lot of these VCs are going to wait to actually deploy that capital until, to our earlier discussion around the mismatch in valuation expectations in private versus the public markets, in 6 to 12 months, that kind of valuation disconnect will probably get smaller, not because, private valuations will go up, but rather private valuations will start coming down, because we've seen that the volatility in the stock market isn't just a blip, but rather it will continue to descend. I for one, not to be overly pessimistic, I don't think the stock market has bottomed out. When you look at prior recessions or economic corrections, it is on average 12 months between peak to trough. And then it usually takes multiples of that for the economy to actually recover in terms of productivity. And so while I do think and hope that because VCs have enough dry powder, they will continue to deploy capital, I think it will probably require more time when we're back in the office and actually having physical meetings. I know that's something that's probably frustrating to hear VCs say, like it's really hard to do a deal over Zoom. And maybe some of that is frustrating, and rightly so, but especially at the early stages, when we're investing in a founder or a team, it really is about the founder, right? And the product will probably change between the time when we write a check and it exits. It did with Lyft, right? When we invested, it was a carpooling software company called Zimride. And then obviously when it IPO'd, it was a company called Lyft that hadn't launched its first product until 2.5 years after we invested. And so we had really invested in the 2 co-founders, John and Logan, and their vision for what the future of transportation would look like. And so we're very cognizant of, when we diligence a company at the seed stage, yes, some of it is about total addressable market, and do we feel like they really have a technology inside, and trying to think through our frameworks of what are the points of inflection that will allow this company to be really large. But a big portion of that is the investment on the founders, or the bet that we're making on them. And a lot of that can only be tested by spending time with them. Now, all that time doesn't have to be in person, but there is something about the nuances of being able to have an in-person interaction that is lost, I would argue, via Zoom. And so I think you're going to see people a little bit reticent to be writing a lot of checks now. I think you are seeing big rounds get done, but I would argue those are companies with pre-existing relationships. So you saw, Stripe, I want to say, raised $600 million. And that was a continuation of a prior round that had closed, and it was led by insiders. And you're seeing a lot of enterprise SaaS or software companies that are raising where they are already at greater than 100 million in ARR. So companies of scale that already have a lot on their balance sheet. So this is intended to shore them up. And so again, there's this kind of flight to quality in the private markets as well. Sizable companies that are going to have the resources to be able to not only survive, but hopefully actually thrive during this period, that had either insiders that are willing to step up and give them more money, sometimes at even like an up round evaluation, or if it's externally led, I would argue it's a high likelihood that those relationships that started pre-COVID. So maybe they had spoken to them in the last round of funding, and maybe there were some sticking points that now both sides have made peace with, and now they're ready to kind of take it to the next stage.
Yeah, and I think it's important for founders to remember that just because it's getting announced today doesn't mean it was signed yesterday.
Right. No, that's an excellent point, right? And I mean, and like we often joke at Floodgate, like we don't necessarily want our companies to announce when they get funding because we don't think that is actually meaningful enough to warrant an announcement, right? Meaning that we want you guys to make announcements when there's huge milestones. Like in fairness to the founders, a lot of times I'll say like, this is important so that I can now recruit, right? And people know I'm fully funded, and being able to have a brand name associated with me is important. So we're supportive of that. But you're right. Like even the funds that are announcing, you know, Mayfield is another one that announced 2 funds that got funded. Those were probably conversations that happened early Q1 or maybe even at the tail end of Q4. But the actual like SEC filings happened more recently.
Yeah, I think that sometimes founders, they just don't have that insight, right? So I always want to remind them that doesn't mean that it just happened, right?
Right.
I do want to talk about some of the market commentary that you do. So every Monday morning, you have your Monday morning market musings on Twitter at Donuts Did This.
Yes.
Right? What did the donuts do?
Well, especially in this COVID period, right? I was joking with friends of mine. I'm like, my stretchy pants have lost their stretch. I'm not sure what that means.
Yeah, right there with you. Yeah, well, tell us more about what you're doing on Monday.
Yeah, absolutely. You know, it's funny because, you know, I suffer from this affliction that unfortunately I think affects women disproportionately, which is I assume what I know, everybody knows. And then a friend of mine pointed out, actually, a lot of people in venture and the startup ecosystem don't necessarily know what to make of public market data. And so if there is a way for you to just provide highlights, and especially right now where even public market investors are having a tough time reconciling macroeconomic data with what they're seeing in the stock markets, that might be something that's helpful. And so it's just a, you know, experiment that we decided to run since I'm sheltering in place like everyone else, right? It's like, how is there a way for us to be able to continue building inroads with new founders and people who may not be as familiar with Floodgate? And so the hope of it is, you know, by no means do I ever have the answer. I think I'm probably err on the side of always caveating what I say. But, you know, there is, I think, some frameworks in terms of how do you think about what leads to volatility in the stock market, or what might be some factors that influence how people should think about valuation multiples, how people interpret information. And again, trying to talk through, okay, but what does this mean if you are an early stage founder or you're a VC that invests in the early stages? What are the ripple effects, and how should I assume there is going to be an impact, and for how long? And so, you know, to the extent that you or anyone who's listening to this have suggestions about topics we should cover, or another way for us to like break things down, I'm definitely open to that feedback, because we want to try to be helpful in providing a point of view.
No, it's awesome. I think, you know, everybody should definitely check it out. And it's, you know, it's a lot of information packed in. I think your video was less than 10 minutes. So
yeah,
it was great.
Where can we find it again? What's the Twitter? What's your Twitter?
Oh, it's at Donuts Did This.
Okay. Thank you.
And I want to encourage everybody who's on the webinar to put their questions in the Q&A chat, because we will in a couple of minutes start going through those. So we'll try to get through as many of those questions as we can. So speaking of the, you know, all of the market moves, I mean, I was very entertained by what happened with oil futures prices this week, forwards. If, you know, startup founders, you know, they have limited time, what are maybe the top couple market metrics they should make sure that they're paying attention to?
Yeah, I mean, you know, it's funny because we talk about the stock market, right? But to your point, there's several indices even within the stock market. And one of the ones that I like to look at is trying to look at the S&P 500 or the Dow Jones, but then also looking specifically at NASDAQ indices. And the reason why I point that out is obviously we're in the technology sector. And what you're seeing is that a lot of of the upward movement in the overall market is because tech stocks are doing so well. And obviously within tech, the FANG, so the Facebook, Amazon, Netflix, Google, are kind of outperforming even relative to how they've done in the past. So I want to say both Amazon and Netflix hit like 52 weeks high within the last 2 weeks, which is crazy given everything else that's going on, but makes a ton of sense given their business models. And the way that a lot of these indices work, so for example, with the S&P 500, not every one of those 500 companies counts for one data point. It's actually skewed based on market cap. So as those companies continue to outperform, their influence on the overall index is actually just magnified. And so I think it's helpful if you're looking at indices to think about, okay, what's the overall market doing? And then looking specifically at tech as well. And then other ones that you can look at are, for example, there's like a Russell index that's more geared towards smaller businesses. So businesses that are a little bit lower in the market cap, to try to understand, one of the concerns right now, especially post-COVID, is how are small businesses going to be able to recover from this? Obviously, the stock market's not necessarily going to be able to show a reflection of like your mom and pop, dry cleaners or grocery store. But thinking through like the different scale impact, I think is something that's important. I will say, one thing that's been jarring for me to see is that in this environment, a lot of the concerns that any of our startup founders have or a small business are also being felt by huge publicly traded companies. An example I would give is real estate, right? Like Nike, Cheesecake Factory, Gap, a ton of companies have come out and said, we didn't pay rent for April, and we have no plans to pay rent going forward. Right? And these are companies that have billions of dollars of cash on their balance sheet, but they have made the tough decision that it's not a good use of their cash going forward. And they're going to immediately start renegotiating those rental agreements or leases, right? I mean, those are very similar discussions to individuals and small business owners saying, I can't afford to pay my rent. And so I'm not going to, and hope that either I'm going to be protected from eviction or that I'm going to be able to renegotiate those contracts with my landlord.
Great. Well, thank you. Thank you for that. I think it's super helpful for founders just to help them navigate around the market. I want to go to some of the questions from some of the audience here. Here's a question from Kavya. How should companies determine the time period that they should plan for alternative revenue generating activities that would take away from their core product development? When should they decide if they should pivot their fundamental business model for a new normal?
Yeah, no, that's a great question. And I have to say that is one of the harder discussions I'm having with founders, is when I feel like their business model is no longer going to be fundable post-COVID. And so there's a whole bunch of different discussions we're having, right? Some of our companies are actually taking off during this weird period. And there I have a concern of like, okay, but are you going to continue to be able to grow post-COVID, or right? Or is this because nobody else can go out into the streets and you're offering a service that brings something into their home? And then there is I have an inherent fear that where people were willing to go in early with lots of money and say, wow, you have a capital intense business. But I think once you get to scale, once you invest, 500 million or a billion, I could see how you could dominate that landscape. I don't know that those types of funders are going to be writing checks going forward. And part of it, even pre-coronavirus spreading, was a little bit of a correction happening in philosophies post, the WeWork IPO getting pulled. That this concept that there's always going to be someone else that's ready to write you an enormous check was starting to, I think, dissipate a little bit. And so what I would say is, again, like, if you are finding that because your core product is no longer kind of saleable during this period, you need to find an alternative, I would encourage you to do that. But to the extent that there might be even like one or two product people or engineers that can still continue to make advancements on your core product, that this is an investment into the future. As long as your core product will still be relevant in a post-COVID world, I think that it's important to try to dual track this.
Yeah, okay, great. Here's another question from Laura. Is the expectation that a decline in valuations will affect seed and Series A companies to the same extent as later stage companies? Some people say that seed should not get affected significantally.
So I am preparing myself that seed will be affected significantly, right? And what I mean is that, again, just as a reminder for people, back in like 2012, a seed round would look like $500,000 to $1.5 million. A seed round these days looks more like 1 to 3 million. And there are some, people use these phrases like mango seeds that get done that are $5 million round. So part of it is that, again, completely independent of what's happening with coronavirus, the size of seed rounds have been getting larger and larger. And with that, you'll have a creeping up of valuations, right? Because people are still not looking to necessarily take on more than 20% dilution for any round. And because there has been so much capital that's available, there is a certain extent of VCs who are willing to go along with the valuation creep to be able to get a foot in the door, especially if they're a multi-stage fund. They're really looking at seed as just like putting a poker chip down, but really they're going to make their money off of, let's say, the Series A or the Series B, where they're going to put the bulk of their fund behind the company. And so I think there is going to be a correction. I, to be frank, have heard Series A firms that have started creeping into seed saying like, we're expecting this to be a reset to like 2014, right? Where again, a seed round looks more like it's $1 million to $1.5 million, and the post money might be like 5 to 6 million. Versus these days, it's not uncommon for seed rounds to get priced at a post money that's somewhere between, let's say, 9 and 11 million. So I think that there's going to be kind of two things that happen in terms of fundraising. One is that the size, or rather the valuation expectations, will need to come down dramatically on the part of the founders, because I think that's what the VCs are going to be waiting to see and then to fund. And then I think the second point is people are going to be looking for a lot more serious milestones to have been met before they come in. And so to that point, what I've really been encouraging our portfolio companies is that if you are not yet monetizing, you have to find a way to elongate your runway enough that you can run a bunch of experiments until you find the one that will be evidence of product market fit, and then be able to have enough data points. So whether that's, months or a year, to show that this is real, right? Like it wasn't just a fluke. For companies that are monetizing, it's about how efficiently can you get customers. And so if you're an enterprise company and you usually have like an enterprise sales cycle that takes 12 months, but your conversion rate is low, that's probably not going to be worth your time going forward during this period, unless you have a ton of funding, right? What you're going to be looking for are quick payback periods and being able to show that you held on to your existing customers, and that they didn't churn for especially like a cheaper alternative, but if anything, instead they expanded their spend with you, that you proved during this period, as your customers were cutting costs everywhere else, that you were that critical to them.
Yeah, that's great. Hard to do.
Yeah.
Right, but that is a compelling story. On that note, I have another question from Raj, who asks, if a Series A round typically takes 6 months, how much time should a founder plan for it to take in the COVID environment?
Yeah, that's an excellent question. So I am still guiding most of our portfolio companies to 6 months, but in my mind, it's that much more important to the second point of what I just said, that your metrics when you go out to have the conversation are solid, right? And so to be frank, there's a lot of fundraising discussions where people do like a soft market check, and then they'll start getting feedback of like, well, it doesn't feel like people are leaning in, so I'm going to press pause and get 3 more months of data and then go out again. You won't necessarily have that luxury, right? And so I think instead what you may want to bake in is less around how long will the conversations take, and more around like, what is the data that I need to have been able to show for people to think that this is interesting. And if it's just a month's worth of data that looks interesting, that's probably not going to be enough, right? People are going to want to see at least like 6 to 12 months.
Okay, got it. So now 6 to 12 months of really compelling data.
Because especially based on the type of business you have, right? If there's seasonality, people are going to want to say, well, now I want to see a year's worth of data, right? And if it's instead during this weird shelter in place period, people may say, well, I think your behavior is going to change post-COVID, so can I see that data?
Yeah, right. I think there's going to be a lot of, we want to see how you do in this COVID world, right?
I think that's absolutely right.
Cool. Why don't we switch gears a little bit to more of the aspiring funder side of things?
Sure.
We do have a fair number of people who are aspiring VCs, and we're coming up on graduation time, right? So we had a question from an anonymous attendee about how did you think about the transition from banking into venture? And then I'm also very curious about your advice for new grads or people who want to get into venture in the environment.
Yeah. And so I guess The first thing I would say is getting into venture is challenging, right? Because there is no direct path. I haven't been on campus for quite some time, but I suspect most venture firms don't have like on-campus recruiting. And it is challenging, and I feel bad admitting this because it's, excuse me, not necessarily how it should be, but venture is very much a closed network and it's very relationship-based. And so I would say the first thing you need to do if you are interested in an opportunity in venture is make it known, right? So get to know VCs, better understand exactly what they do, and then make it clear that you are interested. But when you are making it clear that you are interested, I would say kind of one of my top pieces of advice is, what is your unique angle, right? What is kind of your shtick? How do you pitch yourself in the same way that when people, when founders pitch seed investors, one of the things that I say I look for, there's a couple, but one of them is, why is this your life's work, right? As a seed investor, I want to know, like, why do you feel compelled to build this business? And so even though being a founder is incredibly hard, you're not going to churn, right? And I would say it's the same thing, whether it's VC or whatever job you're going after. Why is this your life's work, right? Why is it that you can't imagine a future where you would be happy doing something else and just be satisfied, right? What is it also about you that is going to make you so special that you are untapping a whole new aspect to the business that doesn't currently exist? For me, when I met with Floodgate, they had cast a very wide net already, right? From what I understand, like a former CMO of Netflix was interviewing for the role, right? That's fairly daunting. Someone who had run all of payments for eBay also, and right? And immediately I thought to myself, like, oh, they're looking for someone very different than me. And I was well past the stage of my life where I was going to try to like fake it until I make it, right? I'm like, I am who I am. And now it's the matter of like, how do I make this compelling enough for you to want to give me a chance? And so for me, my angle was, you guys are great at deploying capital, but I think you have to be intentional about the exits. And that's all I've done for most of my career, right? Is sell companies or take them public. And so I want to bring that lens to the very beginning of how you even evaluate a company before you invest in them. And so thinking through, like, how can you make yourself compelling, that you're not just another version of someone who's already been successful, but you are a brand new version, right? Like, how are you going to define the category that exists now because of you?
That's great. And then I think the next phase of this is another question we have from Solani. What advice would you suggest to a young investor, associate level, to spend their time to best set themselves up for promotions to higher levels?
Yeah. And, so much of that is going to be nuanced based on kind of like the inner workings of any partnership. And I will go ahead and caveat this with, like, partnerships are hard, right? It's the good and the bad of being basically a member of a family, right? There's going to be moments when you feel like, okay, I'm not sure we're all on the same page, but we either disagree, commit, and move forward, or we have to like hash this out. And so I think my advice will vary based on what those inner dynamics feel like. But I suspect for most firms, what matters is that you understand and buy into how deals get done at your firm. And so one mistake I often see, or this would be a mistake coming into Floodgate rather, is if you just want to get deals done, right? Because at some point you're actually going to have negative returns on your time and the time of the partners that you are trying to have sponsor your deals, right? So it is more important to you understand what looks like a great deal to me if you're asking me to sponsor it, versus you just giving me a ton of inbound volume. Because what I want is someone to actually filter it, right? It's like, help me see the vision. Like, what would the investment memo look like? Why don't you start writing it for me, right? What is the narrative? And part of that, unfortunately, which may sound unsatisfying, is that you need to shadow the person well enough and become their apprentice that you can now start asking the questions that I would have been asking if I were the one in the room. And I know that can feel very unsatisfying because it means that you're going to take 100 meetings and maybe elevate one. And you may feel like, well, now I'm not getting credit for the 99 that I've already shown. But it's not about getting credit for having taken 100 meetings, right? It's about, I've now fine-tuned my instincts well enough that I can make investment decisions on your behalf. And I think that's what most partners are looking for in the people that they're going to promote.
Yeah, that's awesome. And I think that that's also this piece of advice of, you need to write the investment memo is also really good advice for founders too.
Oh, absolutely. And so actually, just to give an example, that may feel a little bit more awkward to do at seed, but, kind of a little bit inside baseball when I'm thinking about, like, how do I pitch the fact that I want to do this investment to my partners. At Floodgate, again, it's different at every firm. We don't do a voting system. It just takes one person willing to pound the table and have conviction. And the rest of us may sling arrows, and that either dissuades one of us from wanting to do it, or we have that debate. And sometimes it just makes us want to double down even more. But, a lot of the types of questions we're asking ourselves are, to the first one I had already shared with you guys, why is this your life's work, right? Why is this the founder to solve this problem? Because otherwise, could I see in 2 years this founder either giving up or us saying like, it should be someone else who's leading the team. We want to back the person who's going to be there at the New York Stock Exchange ringing the bell in 10 years. So it's like, why is this the person that we actually want to do? And then another question is, why now, right? Like, why, if I had invested in this company 5 years ago, would it have failed? And why is 5 years in the future too late? And a lot of VCs, if you talk to us about our anti-portfolio, we have invested in companies that someone else then invested in or created a couple years later that were successful, and yet we had to shut down our company, right? And so there's a lot of lessons learned about like, why is now the right time for the company that wouldn't have been true otherwise? And so I think, there's a lot of VCs whose blog, VCs kind of love to create content, right? And so you can get good insight into how VCs think about the companies that they're evaluating. And I would encourage you to go through that exercise of like, write the investment memo for the VC, and then that will become your talk track for the pitch, right? Preempt their questions and actually just make it easier for them. And then when we do later stage investments, I actually do work with our founders to create like a Series A or Series B investment memo. And then that's their body of work that they can actually give to the Series A firms when they start saying like, I'd like to diligence you, and say like, well, I've done some of it for you already, and then let me know what additional questions you have.
That's awesome. That's great. I think we have time for one last question, and this one will be from Jonathan, because I think all of us might need to deliver some bad news or unfortunate news in the coming weeks or months. Jonathan asks, curious regarding your experience with follow-on rounds. If you don't have the conviction to invest, how do you handle that with the entrepreneur?
Yeah, and it's an interesting question. And I would say there's actually an additional nuance I'll share with you, which is how do I handle saying that to my colleague who led that investment, right? Because what's fantastic about the way that Floodgate operates is, we respect each other's voices, and there is, again, because it's not a voting system, no one can overrule someone else, right? And so one of my colleagues may have led a first round investment, and they may bring it to me, and I may say, I actually don't feel comfortable writing additional checks into this company. And I think everybody has their own style. I think mine is the default of like just being super practical and transparent, but also providing very clear rationale. And so, for example, I'm thinking about one of our companies where the founder felt very strongly that the unit economics could work out. I ran a ton of different models using a ton of different assumptions, and I could not get it to work out, right? And so obviously the validity of a model is only as good as the data that goes in, but at some point, using reasonable data or like historical data or what you see your competitors using, you need to have it actually work out. And if I can't get it to work, chances are my math isn't wrong. There's something that is getting in the way of the contribution margins, right? And so I make it very collaborative where the founders are working on it with me, right? And so it's not as if I go away and then come back with a ruling. It's very much like, help me. Like, I want to be the one who's advocating on your behalf. So help me build the business case for it. But I, in the meantime, am going to be asking you all the tough questions that will end up being asked anyway. So let's work on this together.
That's awesome. Well, I have one last comment from the audience, from Betty, that says, can you let Iris know she is a brilliant rock star? Truly impressive. Oh yes, God. Betty, I can. I agree.
That is very generous of you. Thank you. But this has been a ton of fun. I'd love to be able to do it again at some point when we can all meet in person, especially. But to the extent that people have questions, my email address is just iris@floodgate.com. Floodgate being obviously the firm that I work with or work for. But if any of you have questions or I can be helpful to you in this process, please let me know. I will fully caveat that with I may not be that quick in getting back to you because my priority will be the companies that we've invested in. But to the extent that, I can help you navigate these waters, I'm happy to try.
Amazing. Thank you so much, Iris. This was so informative. For everybody on the webinar, we will be sharing the link to the recording. And I just want to give a plug for our webinar next week with Aram Kang, who's the founder and CEO of Coffee Meets Bagel. She'll be talking about love in the time of COVID. So Coffee Meets Bagel, if you don't know, is a dating app. So switching gears a little bit.
I think that's so awesome. And then I saw you, I think you're also going to have Andy Ratcliffe.
Yes, May 5th, we have Andy Ratcliffe talking about product market fit in the time of COVID. So intelligent growth and product market fit, you know, we got to figure it out.
Yeah, exactly. Lots to do. Well, everyone stay healthy and safe. Thank you again for having me. This was a lot of fun.
Thank you, Iris. And Shannon, I'll hand it over to you to wrap it up if you have anything else.
Thank you. Yeah, so you mentioned that this will be posted to our website later. Do you know if we're sending it out actually in the newsletter as well?
Yeah, so that's a good point. We have a, please join our newsletter. It's at hellowafa, WAFFA.org. You can sign up. We'll be sharing a link to it there, and then all of the attendees will get a thank you email with the link, and also the @DonutsDidThis handle.
Yes. All right, well, thank you also. Thank you so much for coming, and we'll be in touch shortly.
Great, thank you.
Thank you.